The energy relationship between the United States and Canada is one of the longest and most vital in the world. Despite the US emerging as a global energy powerhouse with its shale revolution, it still relies on its northern neighbor for a substantial portion of its oil, natural gas, electricity, and even critical minerals. Today we ask, does the US really need Canadian energy? In this deep dive, we'll explore the history of this bond, examine its economic and geopolitical benefits, assess the challenges posed by shifting policies and tariffs, and look ahead to what the future may hold for North American energy security. From record-breaking oil imports to the intricate web of pipelines and refining infrastructure, our video today will reveal why Canadian energy is so indispensable to the United States, and why any disruption in this relationship could have far-reaching consequences. Stay tuned as we break down this unbreakable North American bond. For decades, the United States and Canada have been intertwined through energy trade. Even before the shale revolution, the US was heavily dependent on Canadian oil and natural gas. Historically, Canada, thanks to its vast oil sands and abundant natural resources, became the primary supplier of heavy crude oil and natural gas for US refineries, especially in the Midwest and Gulf Coast. According to the US Energy Information Administration, more than 50% of crude oil imported by the US comes from Canada, while nearly all natural gas imports have historically been sourced from our northern neighbor. This deep integration wasn't accidental, it evolved from decades of mutual benefit, where Canada's heavy, viscosity-rich crude oil perfectly complements the refining capabilities of US plants that are designed for such feedstock. These historical ties have created a partnership that not only supports economic growth, but also strengthens energy security on both sides of the border. But history is only part of the story. Let's now examine the concrete benefits of this relationship in today's energy landscape. Economically, the US-Canada energy relationship is a powerhouse. In 2023, bilateral energy trade, including oil, natural gas, electricity, and even uranium, reached record levels of over $150 billion USD. For many US refineries, Canadian crude is not just an alternative, it's a necessity. Heavy crude, like Western Canadian Select, feeds refineries in the Midwest that are specifically designed to process this type of oil. Analysts warn that if US access to Canadian oil were to be restricted, refineries would either face soaring feedstock costs or be forced to reconfigure their complex operations, a move that could delay production and increase fuel prices. Geopolitically, this energy tie acts as a stabilizing force in North America. Canadian energy exports help the US reduce its reliance on unstable or adversarial sources of oil and gas, such as from regions in the Middle East or OPEC countries. With American shale oil production facing challenges, declining reserves and rising extraction costs, the US increasingly turns to Canada as a reliable partner. Moreover, Canadian exports aren't just about raw materials. They also include electricity and critical minerals essential for the US industrial base and defense sectors. This interdependence has helped forge a mutually beneficial economic framework that contributes to energy security, price stability, and even diplomatic leverage in global markets. Despite this solid partnership, recent political developments have threatened to disrupt the balance. US President-elect Donald Trump's tariff proposals, intended to address issues like illegal migration and drug trafficking, have raised fears about placing a blanket tax on Canadian energy exports. A 25% tariff, even if later adjusted, could lead to immediate cost shocks for US refineries and consumers, as described by analysts warning of potential pump price hikes by up to 30 cents per gallon in the Midwest. On the Canadian side, industry leaders and government officials warn that such tariffs would not only undermine decades of trade history, but also force Canadian producers to consider alternative markets, perhaps shifting more exports to Asia via the recently expanded Trans Mountain pipeline. Such a shift could erode the US's dominant position in energy supply, as noted by private equity CEOs who suggest that tariff threats might actually accelerate Canadian pipeline development to non-US markets. But tariffs aren't the only challenge. Regulatory roadblocks in Canada have also hindered energy diversification. Over the past decade, numerous LNG projects and new pipeline proposals have stalled due to complex approval processes and environmental assessments. These delays have kept Canada overly reliant on the US market, even as global demand for energy grows and alternative trading partners become more attractive. Furthermore, geopolitical tensions have led some Canadian policymakers to call for diversifying export markets and reducing dependence on a single buyer. While such diversification could strengthen Canada's long-term bargaining power, it also risks destabilizing the current energy equilibrium between the two nations. Debate is raging over whether the US truly can, or should, reduce its reliance on Canadian energy. Some US policymakers argue that the nation's burgeoning shale production and recent investments in renewable energy might someday diminish the need for Canadian imports. However, experts point out that the quality and characteristics of Canadian crude, particularly the heavy grades essential for certain US refineries, mean that a complete substitution is far from feasible. Political rhetoric further complicates matters. President Trump has at times dismissed the value of Canadian energy, questioning why the US should continue to rely on imports when it could ostensibly produce its own. Yet, as one industry executive put it, the US may be the land of opportunity, but when it comes to heavy crude, Canada is the lifeline. Analysts warn that ignoring this interdependence could lead to higher energy costs, supply shortages, and even a destabilized global oil market. US refineries are finely tuned machines that depend on the unique properties of Canadian oil, especially as domestic production shifts towards lighter, sweeter grades, explains an energy analyst from Reuters. Looking ahead, what does the future hold for this energy partnership? For the US, the challenge will be to balance new domestic production with the critical need for Canadian heavy crude and natural gas. For Canada, the imperative is to remove regulatory barriers that have delayed infrastructure projects like LNG export terminals and new pipelines. Increased cooperation on cross-border energy projects could not only shield both nations from tariff-induced shocks, but also cement their role as global energy leaders. Many experts agree that a coordinated North American energy security framework is needed, one that modernizes trade agreements like the USMCA, harmonizes environmental and safety standards, and invests in next-generation infrastructure. Such a framework could help both countries navigate the shifting energy landscape and emerging geopolitical challenges while ensuring that consumers on both sides of the border continue to benefit from affordable, reliable energy. In a world of shifting geopolitics and evolving energy technologies, the US-Canada energy relationship remains a bedrock of stability and prosperity. The United States may produce record amounts of shale oil, but when it comes to heavy crude, natural gas, and even critical minerals, Canada is indispensable. As debates continue over tariffs and policy shifts, one thing is clear: our energy futures are inextricably linked. What do you think is the key to preserving this vital partnership in the face of emerging challenges? Thanks for watching. Stay informed, share your thoughts in the comments below, and be sure to subscribe for more in-depth analysis on the issues that shape our world.
Life's so